Hi, welcome to another episode of Real Life CFA. In this series, we'll talk about all the key concepts in the CFA curriculum and their real-life applications. Without further ado, let's get right into it. Today, we're going to talk about inflation and why should we care about it. As always, we'll start with the definition. What is inflation? Inflation is the decline of purchasing power of a given currency over time. It's a quantitative measure of the rate at which the decline in purchasing power occurred can be reflected in the increase of an average price level of a basket of selected goods and services. There are mainly two types of inflation. In general, consumption-driven inflation and production-driven inflation. Consumption-driven inflation is caused by increasing demand for goods and service. For example, as wages grow, price for luxury goods increase. But of course, luxury good is only one type of goods, and inflation is about a basket of selected goods. We'll talk about it later. Consumption-driven inflation is measured by CPI, Consumer Price Index. Production-driven inflation is generally caused by increasing costs of production. For example, if price of wage and raw materials go up, producers will transfer some of the cost increase to consumers through increasing the sales price of their goods. Production-driven inflation can be measured by PPI, Producer Price Index. Let's talk about CPI first. This is the formula for CPI. You need to set a base year, which is C0, and then compare whichever year that you want to analyze with the base year by using this formula. Easy enough. So what goods and services get considered in the CPI calculation? So the basket of goods include food and beverages, housing. Note, housing only includes rent, utilities, and furnitures, not property price. Clothing, transportation, medical care, recreation, education and communication, and other goods and services including tobacco and smoking products, haircuts and other personal services, and even funeral expense. There's another important concept that's called core CPI. The difference between core CPI and CPI is that core CPI excludes food prices and energy prices because those prices are volatile. This is the chart for CPI versus core CPI from 1984 to now, with 1984 as the base year. We can make the following two observations. First, core CPI has been generally lower than CPI because energy and food prices are excluded. Second, the trends have been pretty much linear. This means that our central bank has been doing a great job at keeping price levels steady. Otherwise, the lines are going to look much more bumpy. Next, let's talk about PPI. The PPI formula is the same as CPI, but with a different basket of goods. There are three ways to classify the goods included in the basket. The first one is industry classification. It measures the revenue received for the industry's output sold outside the industry. The second one is commodity classification. It organizes products and services by similarity or material composition, regardless of the industry classification. And the third one is commodity-based final demand minus intermediate demand. It regroups commodity indices for goods, service, and construction at the subproduct level, according to the type of buyer and the amount of physical, processing, or assembling the product have undergone. Doesn't matter which classification you follow, you're likely to end up with a similar result for your calculation. This is a chart for PPI from 1984 to now, with 1984 as the base year. We can see that PPI is much more volatile compared to CPI. This is partly because PPI is heavily influenced by commodity prices, which is highly volatile. There are three situations that no one wants to see. First, stagflation. It means slow economic growth and relatively high unemployment, and increasing inflation at the same time. An example would be in 2008, after the subprime bubble burst, oil price and inflation shot up. It created a big problem for the Fed because the Fed usually boosts liquidity to save economy from recessions by lowering interest rate and injecting cash into the financial system. But at the same time, these actions will further push up inflation. The second one is hyperinflation. Hyperinflation, in my opinion, is more dangerous than stagflation because it means inflation is out of control. An example would be the hyperinflation in Germany in 1920s. By November 1923, $1 was worth more than 4 trillion German marks. One loaf of bread cost around 160 marks at the end of 1922, cost 200 billion marks by late 1923. These extreme circumstances had paved the way for the rise of Adolf Hitler. And the last one is deflation, which I think is the most dangerous one out of the three. Deflation means a general decline in prices for goods and services. It's dangerous because no one would spend money if the economy is in a deflation, because all goods and services will become cheaper tomorrow. So why would you buy today? This mentality would trigger the economy to spiral into deeper troubles and reduce economic activities to an absolute minimum level. An example would be Japan's deflation in 1990s. The Bank of Japan and the government tried everything they could to eliminate deflation by reducing interest rates and quantitative easing. But nothing worked, and deflation persisted until 2006. This period is referred to Japan's lost decade. Lastly, let's briefly talk about the role of central banks. The main responsibility of central banks, including the Federal Reserve, is to control price levels or inflation and ensure the well-being of the banking system. Let's look at the Federal Reserve specifically. The Fed has a dual mandate, meaning its primary goal is to achieve both full employment and a stable price level. Central banks have multiple tools to help them achieve their goals. It includes cutting or hiking interest rates, adjust banks' reserve requirement ratio, open market operations, and quantitative easing. All of these tools have one common goal: to make sure that there is enough liquidity in the system. Why is liquidity so important? Well, you can think of the economy as your body, and liquidity is your blood. Inflation also influences the shape of the yield curve and asset prices. If you would like to learn more about the yield curve, please check out our yield curve video. If you have any questions on this topic, or have anything that you want us to talk about in our future videos, please leave a comment down below. If you enjoyed our videos, please subscribe and smash the like button. You can also follow us on Twitter or visit our website at www.ironhawkresearch.com. We'll be posting weekly market commentary and article about things that you might want to know in finance. Thank you very much for watching and see you next time.